everyone. Welcome to KSAR's seminar today. I'm Özlem Young, and KSAR Research Fellow and lead for our research team, Poverty, Precarity, Savings and Debt. I'll be your host in this session. Today we welcome to Fabrizio Valenti, who will be presenting the findings of their study on the financial decision-making and behavior in migrant households in India. Fabrizio is a senior consultant at the KSAR Consulting Group in Canada, providing advisory and research services to public and third sector organizations. He's currently leading a study on the effects of Canada's temporary foreign worker program on the labor market for Canada's Ministry for Employment and Social Development. Fabrizio's areas of expertise include migration, financial inclusion, social protection, and local economic development. Before joining the KSAR in 2022, Fabrizio was a lecturer in financial inclusion and the head of the financial inclusion team within LEAD at Korea University in India. As part of this role, Fabrizio led a team of researchers investigating the financial decision-making, access to social protection, the role of digital tools, innovative method insurance products. He also worked as a policy and immigration information manager for Save the Children in Sierra Leone, supporting the Ministry of Social Welfare, Gender and Children's Affairs. He also worked as a technical advisor for human and sustainable development and was a fellow at UNDP Indonesia, where he assisted the government of Indonesia in consolidating its governance structure for the achievement of the sustainable development goals and so on. So welcome, Fabrizio, and thank you to be with us today.
Thank you so much, Özlem, for the introduction. I will be sharing my screen so we can start with a presentation. Okay, so let's start. So hello again, everyone. My name is Fabrizio Valenti, as Özlem mentioned. I'm a senior consultant at the KSAR Consulting Group, and I'm based in Ottawa, Canada. Today, we are going to discuss the result of a study that my co-authors, Vineet and Shashank, who actually are in the virtual room today as well, and I conducted while we were all working at LEAD at Korea University. There is a research institute based in India, which some of you actually might know as IFMR LEAD, or for perhaps the older crowd in the virtual room, the Center for Microfinance. But again, before we begin, I wanted to thank all the people working at KSAR, and especially Özlem and Helen, for organizing this great series of webinars and inviting me. It is really a pleasure to be here. And of course, thanks everyone for attending, and I hope you will find the presentation interesting. All right, without further ado, let's get into it. All right, so this is just quite a quick summary of what we're going to discuss today. We will start with an overview of the motivation objectives of the study. I'll talk a little bit about the study design, and I will go into some high-level descriptive findings before diving into our regression analysis and findings, and of course, some conclusions. So normally, when we talk about migration and specifically financial decision-making among migrants, we tend to focus on either the factors that lead people to migrate or the decisions that migrants make in terms of the amount of remittances they send home, right? So, and alternatively, when we focus instead of the migrant, when we focus on the migrant's households, normally at origin, we tend to treat remittances as some sort of a windfall gain that households allocate towards savings, consumption, other expenses. And instead, what we try to do with this study was taking a more perhaps holistic approach to financial decision-making in migrant households, and we sought to shed light on the role, preferences, and influence that different actors, specifically the migrants themselves, their spouses, and other people living in their households have over financial decisions. And we'll see which financial decisions. We have selected 7 types of financial decisions. So what we're going to do when looking at these financial decisions, we're going to look into who is the primary financial decision maker in the household. across different types, as I said, of financial decisions, and how this is influenced by different factors, both at the individual and the household level. Then we will flip our analysis and see how migration and household characteristics, as well as who is actually the financial decision maker itself, affects certain decisions. And also note that throughout this presentation, we will be talking about domestic migrants in India. So not international migrants, but domestic migrants. This is a very important segment of the population in India. We're talking about a true engine of the economy, fueled by at least 139 million people that move approximately $24 billion a year just in remittances. These are enormous numbers, as you can see. And these are also figures from 2011. So they're very dated. And I guess, that they have only increased in the past 12 years. Okay, so in terms of design, we used a mixed methods approach. We conducted some qualitative interviews with a variety of sector experts and financial institutions to inform and add context to our quantitative work as well, to our interpretation. And our quantitative work especially focuses on migrants from Bihar, Jharkhand, and Eastern Uttar Pradesh, which in the map are the states that are colored. So these ones over here. We partner with a local NGO called Gramvani, and what this NGO does mostly is managing a few IVR system. IVR is like interactive voice recording systems that users can subscribe to in order to receive information about social welfare programs, the weather, agriculture, and local relevant news. So starting towards the end of 2020, we leveraged these IVR systems and Gramvani's strong user base to recruit respondents. Essentially what we did was sending out an IVR blast, asking potential respondents some basic screening questions and their consent to opt in the survey. This is essentially means, a pre-recorded message, one of those pre-recorded messages, annoying ones that people receive. And we asked them a number of questions. People could respond using their phones and could give their consent to be contacted again to participate in the survey. And I think that this strategy itself is an interesting contribution of our project for researchers that are trying to reach out to a large potential pool of respondents in a rapid and cost-effective manner. And in this way, we ended up reaching out to 1,200 respondents, both migrants and family members of migrants, from approximately 600 households. Whenever possible, we also tried to interview people from the same households. And we concluded our survey approximately in spring 2021. So essentially, what we had at the end of this process were 3 small data sets, one containing only migrants, one containing people belonging to households with at least one migrant, and one that matched members from the same household from data set 1 and data set 2. Now let's take a look at some of the key characteristics of our sample. First of all, we observed that every single migrant in our sample is male. This was not intentional, but it's just a consequence of who constitutes the main audience of the Gramvani IVR systems. That doesn't mean that we don't have any women at all in our sample. It's just that all the women we interviewed were either the spouse or some other relative of the migrant, never the migrant herself. So the descriptive statistics that emerge from our respondents are in line with the expectations of how a household in rural, low-income areas of India might look like. What I would like to point your attention to is the income data. We see that the average income of the average total income reported by our respondents is 10,764 rupees a month, which is it's approximately $175 a month. And then most of the respondents reported the primary source of income for their households are remittances, 72.5%, which obviously highlights the importance of migration for these households. Just, because people might not be familiar with that, a quick note about caste data. These categories, meaning scheduled caste, scheduled tribe, and the very unfortunately named other backward caste, are official categories set up by the government of India, which essentially keeps and updates a list of castes for each category. And special programs and social welfare transfers are available for each group, depending on their needs. And scheduled castes and scheduled tribes are considered to be the most disadvantaged groups, followed by other backward caste, and then the general caste category. We are aware that not all migrants are the same, and we have differentiated the migrants in our sample based on 3 dimensions. First of all, duration of the migration cycle, then skills of the migrant, and then destination of the migrant. We will use these migrants as independent and control variables in our regressions. And in terms of duration, we follow the definitions from the Indian census and refer to migration of up to 6 months as temporary or seasonal, above 6 months as semi-permanent, and permanent as permanent, of course. And for skills, we use ILO's International Standard Classification of Occupations to classify migrants according to their skills, with level 1 being the lowest out of 4 possible levels. Most of the respondents are construction workers and factory laborers, which falls under the lowest skill level in this classification, that is level 1. In terms of destination, the only thing that I would like to point out is that we were surprised to see this much variation. That literature on this topic tends to say that people from the areas that we were investigating tend to migrate only or predominantly to places like Delhi or Mumbai, that is in the west of the country. And instead, what we see here is almost like an equal split between the possible destinations of migration. Okay, and we conclude our descriptive analysis looking at some key financial behaviors. First of all, we find that remittances are received by the migrant father or the migrant spouse in over 70% of our sample. Very interestingly, we notice that 80% of our respondents use formal channels to submit remittances, with bank-to-bank transfers being the most common. And this is in contrast with a significant chunk of the literature on this sector, which reports informal channels being very popular among Indian domestic migrants. A plausible explanation for this discrepancy is actually a quite simple one. That is that much of this literature is very dated. As we've seen before, we've seen some data that is very old. And given the advancements in financial inclusion in India, migrants' preferences might have changed. At this point, we see that bank account ownership is nearly universal in our sample, and that some of these our migrants, actually most of our migrants, 3/4 of our migrants report having a bank account at destination as well as origin. So a lot more advanced than we expected in terms of financial inclusion, and that would explain, why bank-to-bank transfers are so popular. They're cheap, they're easy, and they're feasible for this group. However, this reliance on formal channels is not observed in other financial behaviors. For instance, we noticed that that 28% of migrants subscribe to an average of 3 loans in the past 18 months. However, only 3% of respondents reported having borrowed from financial institutions, the rest from family, friends, and other informal channels. And we observe a similar pattern at source as well, where also approximately 28% of households signed up an average of 2 loans, but only 17% from formal sources. Now, before we jump to any conclusions, it is important to remember that data was collected approximately 9 months after the COVID-19 pandemic started to be felt in India. And it is possible that this result might be caused by formal credit being harder to obtain in this period. Although, even if that was the case, I don't expect this 3% to jump to, I don't know, an 80% or a majority. All right, in terms of our modeling and our regression strategy, we use simple multinomial and fractional logistic regressions to model financial decision-making and behaviors over our matched dataset. We begin by identifying factors that influence the likelihood of the principal financial decision maker being the migrant, just using a simple logic. Then we employ a multinomial logistic regression to model the likelihood of other household members to be the financial decision makers relatively to the migrant. And finally, we use a fractional logic regression to show how certain individual and household factors influence certain financial behaviors. And specifically, we focus on what we consider to be desirable financial behaviors, namely savings and expenditures on education and healthcare. So starting from the first group of analysis, we begin by using, as I said earlier, a logic regression to understand what individual and household characteristics this individual of the migrant and household characteristics are correlated with the migrant being the primary decision maker over 7 different types of financial decisions over here. We conduct this analysis for 2 scenarios. First, when the migrant is at home, and then when the migrant is away. And we see that there is a shift, obviously, in how financial decisions are made when the migrant is not at origin, but is at destination. We are going to use these 7 categories of financial decisions throughout all of our analysis. So also in the other regressions that we'll see afterwards. So now going into the regression results themselves, if you're reading the table on the left, please note that the first row represents odds ratios for the scenario when the migrant is at home, while the second row refers to the scenario when the migrant is away. It's odds ratios, so anything that is above 1 is, quote unquote, positive, more likely, and below 1, between 0 and 1, it's less likely. So looking at, without going into specific individual financial decisions, but looking at trends and insights emerging across financial decisions and beginning with the individual characteristics of the migrant, we notice that an increase in years since first migration results in an increase in the odds of the migrant being the decision maker across pretty much all decision types. With experience, we see that migrants seem to acquire more influence on financial decisions. And additionally, the literature shows that migration increases financial awareness and sophistication, which is consistent with these findings. And it appears that more experienced migrants have more influence over financial decisions. And intuitively, we also see that higher remittances are associated with the migrant being more likely to being in charge of large financial decisions. And possibly this is because of a higher making more contributions to overall household income, and which leads to greater financial influence. Looking at household composition covariates, we find that as household size increases, the odds of the migrant being decision maker decrease, as more members may vie for a say in the decision-making process. The same reasoning holds true when there are more financial contributors in the household, and other household composition characteristics, though we find that are important as well. As the number of children under 18 increases, the odds of the migrant being the decision maker increases across most categories. And we argue that in our sample, most of the children that are in these households are actually the children of the migrant themselves. So that would explain why having more of their own children in a household increases the influence of the migrant. And on the other hand, though, we notice that the presence of an older male in the household significantly and substantially decreases the migrant's decision-making power for most types of decisions, almost 3 times less likely to be decision makers in some cases. And we'll see throughout our study at this group, older males, normally the migrants' parents, are very, very influential in decision-making processes in a household. So moving on to the second type of analysis that we ran, using a multinomial logit, we expanded our analysis to all other household members. Now, this kind of regression is used to model cases where the dependent variable has more than 2 response categories. In our situation, we actually have 5. That is, the migrant himself, his spouse, an older male in the household, as we said earlier, normally the migrant's father, an older female in the household, usually the migrant's mother, or what we lumped together into other household members, normally the migrant's siblings. So for the purpose of the analysis, we selected migrant as the financial decision maker, as the base category, against which all others will be compared. So in terms of interpretation of results, all odd ratios coefficients represent whether a household member, say, for example, the spouse, is more or less likely to be the decision maker relatively to the migrant. So to illustrate this with an example, look at the table at the bottom right of the slide. In this case, we see that the likelihood of an older male being the primary financial decision maker compared to the migrant decreases as the number of years since the first migration increase. I hope that's clear. Before going into results, keep in mind that all results are, again, for the migrant is away scenario, because there was not enough variability in our sample to conduct any meaningful analysis when the migrant is at home. When the migrant is at home, he is the primary financial decision maker. And due to space constraints, I really can't present tables, but we will focus on results and trends across financial decisions. All the tables, though, are in the appendix to this deck for anybody who is interested. But imagine having this for 7 decisions, it would be unwieldy. So in the next few slides, we'll see results for different covariates, starting from migration-related covariates and then moving to household composition covariates. Okay. Now, this very colorful slide, what does it tell us? We begin from the left, top left. So we begin our analysis looking at how different migration-related covariates are correlated with increase or decrease likelihood of various household members being the primary financial decision maker vis-a-vis the migrant. So first of all, we see that in general, a more experienced migrant, that is someone that has migrated many years ago, seems to be more in control of financial decisions, as this variable is correlated with all other household members, being less likely than the migrant to be the primary financial decision maker. Now, what's interesting here is that the only exception is the migrant's spouse. So we hypothesize that there is a degree of power sharing, perhaps, between the migrant and their spouse. So that the more the migrant acquires financial decision-making power, the more the spouse does as well. And we see that this tendency seems to be confirmed by the fact that we see a similar pattern with migrant skills, with the wives of high-skilled migrants having a greater influence over certain financial decisions. Now, this is not to say that this happens, this power sharing dynamic, so to speak, happens all the time. For example, we see that an increase in the size of remittances, which obviously increases the financial influence of the migrant and therefore the power, doesn't translate in an increased role in financial decision making for the spouses. So there are some exceptions. And finally, we see that the duration of the migration cycle, so how long does the migrant is away for each migration cycle, is correlated with an increase in financial decision-making role of other household members, intuitively. But here, an interesting result that we observe is that the migrant seems to retain control over decisions on expenditures on education and health. And this honestly is a result that I think merits further investigation. It's interesting, but at the same time, a bit odd to explain. we hypothesize that this might be due to the perceived importance of these decisions, which might lead the migrant to try to retain control over that. But I think that this is something that we will need to investigate further to confirm or disprove. Now, moving to household composition covariance, we see that as the size of households increase, we posit that the financial power of the migrant decreases, and therefore the influence of other household member increases, with the exception of their spouse. This is essentially the same sort of marital power sharing dynamic that we observed in the previous slide, only going in the opposite direction. The financial influence of the migrant is negatively correlated with the number of family members that earn an income as well, down here, obviously. And we see in this case that the decision-making power of other household members, and especially those that we ended up lumping together into this other household member category, increases significantly, which is, I think, intuitive, as these are often the migrants' siblings, often of working age. Now, in our sample, as we said earlier, most of the children that live in the migrants' household are their own. And therefore, it's not surprising to see that the presence of children is correlated with a higher likelihood of the spouse being the primary financial decision maker on a number of important expenses, while the role of other household members decreases. Finally, I think it is interesting to see that the marital power sharing dynamic that we discussed so far seems to apply also to who normally are the migrants' parents. In fact, the presence of an older male in the households who we seen as a lot of power over financial decisions is correlated with a bigger decision-making power of older women as well, who are normally their spouses. Okay, so this concludes the second set of regressions that we ran. Now, what we do is flipping the focus of our analysis from the financial decision maker to the financial decision. So we are trying to see what makes these households more likely to save or allocate expenses to a certain in certain directions. So as I just said, we're looking specifically into the two specific financial behaviors. So the first one, as I said, is whether a household saves or not. It's a binary decision. So we use a logit regression. And the second is allocation of expenditures, allocation of total expenditures towards education and healthcare. And this is not a binary decision because it's how much of the total expenses is allocated towards this. So we use a fractional logit model. So for both behaviors, we run two specifications of the model. The first specification looks at how decisions correlate with the category of the decision maker, being either the spouse, the older male, older female, or a older household member. And we keep, again, the migrant being the decision maker as the base. And the second specification of the model looks only at the gender of the primary decision maker. Now, what I'd like to add before we dive into results is that in this last set of regressions, we introduced some new covariates that we built leveraging our match data set. Specifically, we introduce a variable measuring financial decisions information asymmetry between the migrant and household members. So essentially, we ask some information about certain financial decisions to both the migrant and the household member. We check how much they aligned or they diverged, and we built an index of financial information asymmetry. And another covariate that we built for these regressions is one denoting whether financial decisions are made in consultation with other household members or not. Okay. So beginning with savings, we see that in both specifications, the coefficient for average monthly household income is positive and significant. And this is consistent with literature globally. Moving on, we see that household size has a negative effect on whether a household saves a larger, as larger households are also associated with an increase in the number of dependents. On the other hand, the presence of more household members contributing to the overall income is correlated with higher savings as well. We observe some interesting gender trends in our results. In specification 2, we observe that when decisions on savings are made by a woman, the household is twice as likely to save. A result that is also like directionally only confirmed by specification 1 as well. We also observe that the education level of the migrant is positively correlated with the likelihood of the household to save. What could be perhaps the most interesting result of this analysis, however, is what emerges from the bottom of the table. And we observe that higher information asymmetry between the migrant and the household members has a negative and significant effect on the likelihood of the household to save. And finally, we also find that households where decisions on savings are made in consultation with other, of course, members, are more than twice as likely to save as compared to households where decisions are made by a single individual. So when we take these two results together, there is a strong argument to be made about the importance of communication and sharing decision-making responsibilities to obtain desirable financial outcomes. And then finally, this is pretty much what we're almost at the end of the presentation. We look at household expenditures on education and healthcare. So we see that in both specifications, average monthly household income has a large, positive, and significant effect on the proportion of household spending on education and healthcare. That makes sense. An interesting finding, however, is that the number of financial contributors in the household is significantly and negatively correlated to spending on this category. Maybe, this is our hypothesis, is that these additional earners end up not contributing much to the children's education, who will be their nieces and nephews, meaning that proportionally a lower share of the household income ends up being spent on education. The type and gender of the financial decision maker does not appear to be significantly correlated with expenditures on health and education, while on the other hand, the migrant's education does across both model specifications. And in addition to this, we find that migrants' risk preferences have a negative effect on the share of spending on education and healthcare by the household. So more risk-prone migrants invest in this kind of expenses less. In the literature, being risk-prone is correlated with being less likely to save. And we assume that this might have a similar effect on expenditures on health and education. We also notice that using more sophisticated financial tools like insurance, perhaps, is negatively correlated with expenditures on health and education. And initially, we were quite surprised by these results, as it seems quite counterintuitive. Our assumption here, our hypothesis, is that households that have access to more, as we said, sophisticated financial tools as insurance are less likely to incur into out-of-pocket expenses related to health and education. So that might explain this negative correlation. And finally, and consistently with the findings on savings, consultation among household members is found to be highly positively and significantly correlated with the share on expenditures on healthcare and education. So this sort of consultation process seems to be very important for to foster desirable financial decisions. So in conclusions, we went through a lot of material this afternoon. And in terms of key takeaways, our study demonstrates that both individual migrant and collective household characteristics determine financial decision and financial decision processes taken by migrant households. I think that our study is just a first step into studying these dynamics in greater detail. But we've seen that migrants play an important role, an important financial decision-making role in their households, even when they're away. And that this is due to, well, migration itself. Bringing home remittances, especially over a longer period of times, means that they accrue more and more influence and control over financial decisions. It also appears that some of this influence is shared with their spouses, which is quite interesting, especially when the migrant is away. but we also see that traditional roles and power dynamics are still important, with older males retaining a great degree of influence over financial decisions. And finally, we've seen that households where financial decisions are made consultatively and where there is a lower degree of information asymmetry over financial decisions, these households tend to adopt desirable financial behaviors. And in practice, financial products perhaps that influence and foster these behaviors, for instance, joint accounts, could have a positive impact, although there are a number of other considerations about women's empowerment to be made about the adoption of joint accounts. So that's pretty much it. I hope that these insights will spur some interest and will prove to be valuable among both practitioners and researchers. And so thank you all for your time and attention, and do not hesitate to reach out to me for any questions, clarification, or comment. My email is right here, and I look forward to the Q&A. Thank you.
Thank you, Fabrizio. That was great. Yeah, we just learned about the context of the India and the decision-making processes and outcomes